Blackstone is one of the world's leading investment firms, managing about $500 billion in assets. It is also known as a company that played a role in buying real estate after the last mortgage crisis, becoming one of the single largest owners of residential properties globally. And with that, some criticism came its way, including from the UN's housing advisor. When I sat down exclusively for a broadcast with the CEO and co-founder, Stephen Schwarzman, I got his side of that story.
Basically, what we did after the crisis with residential housing is the regulators dramatically increased the down payments needed to buy a house. And so before the crisis, it was like 5 or 10%, and that encouraged an enormous number of people to buy houses. And when things collapsed economically, prices of houses went down 30, 40%. What the government did was increase the down payments up to 20, sometimes 25%. So what happened? Nobody could afford to buy a house, even though houses were down in price. The money you had to write a check to buy a house was so big, the market just like couldn't recover. So what we did is we bought, about 50,000 houses. It was pretty small. In the context of the United States, it was like 0.5% of the homes that are rented, but close to 1/10 of 1% or less of total homes. It was almost nothing in the scale of the whole thing. But what we did is we spent about $25,000 a house to fix them up, and then we rented them to people who didn't have the money, which was almost everyone didn't have the money to be able to buy a house. And we bought in places that typically would have very good school districts. So people would be able to move into those houses and send their children to good schools. And we hired all these workers to fix the houses. So we think we did like a very good thing. And we've actually sold all of our stock, with that program. We doubled our money for our investors, who are pension funds, police, fire, teachers, government officials. So that's where the profits basically went. But in terms of a force for good, I think we did a really good thing for society.
You mentioned the effect of monetary policy and the odd situation that we're in, including negative yielding rates globally. How does that change what you're thinking about returns you can expect, how you capitalize, how you finance? Are you having to rethink some old rules here?
Well, some of that doesn't affect things too much. It makes money cheaper. So people tend to have higher values they pay when it costs less to finance it. The amount of financing isn't that much higher. In fact, it's lower on the things we buy, because if the prices are higher, the banks and everybody else doesn't want to give us more money, and take more risk. What happens is you put up more equity. Mm-hmm. So the leverage in structures has gone down materially. So from the perspective of the banks and the system, things are quite safe. The risk is actually what the return will be on the
asset
equity.
Valuations.
And on as a result of putting more money in to buy something. So what it does is it makes us much more cautious. And it's a little like playing hockey. What is a normal game? You get 30, 35 shots on goal. That's a normal environment. That's when interest rates are a little different. Now we have a different environment. We only get like 5 shots on goal. Now, if we pick those shots right and we're open, we can still score 3 goals a game, and we have a really good shot of winning the game. But we have to recognize we don't get those extra 25 shots. Most of which aren't well conceived in the first place, which is why you don't have high-scoring hockey games. But we can still put money out, but we have to be much more cautious.
So where are you looking? Because not only are you cautious for those reasons, but you're also, there are some other very large players. You yourself are now large enough that the deal flow will change just by definition.
Yeah.
What's interesting?
The way we do things, almost every one of our business lines, whether it's private equity or real estate or credit business, and we do a variety of other types of things, we're typically try and be in pretty much accomplished it, being the largest in the world. Now, why do we do that? We do it, among other reasons, because there's less competition. With financial assets, there are always bigger and bigger companies you can buy. And if there are very few people competing for those, just because of the scale, that in effect gives you an advantage. You're not in the crowd. We always have some competitors, but ironically, we've always had, somewhere around 7 competitors. Now it's less, and that's been for 30 years. The names of those companies tend to change, but the number of them is about the same, and we've been fine during that whole period.
Is there a place in the world you're avoiding right now? Is there a geography that you find particularly difficult?
The answer is there are lots of places, that you avoid. So some are characterized by, bad governments, inhospitable governments, and the easy thing would be something like a Venezuela, and there are a variety of countries that basically don't have a rule of law. If you live in Canada, you assume, if you don't travel much, that everybody's more or less like you, except they may look different, but they got to have something that's a similar system. That's not true. There are a lot of places in the world where there either is no actual rule of law, or where laws just don't get enforced, or they get enforced selectively, so you can't rely on them. So there are large parts of the world, some in Asia, some in Africa, where some in Southeast Asia. There are many countries where it's quite difficult. I have a simple rule that I only like to invest in countries that I'd like to visit twice.
That you go back to?
Yes, that I'd like to go back to twice. Anybody likes a place once, but would you really like to go there on a repeat basis? Usually, if you don't want to do that, that's a place to stay away from.